In this second exercise, we're going to look at another company, Standing Desk Inc. The big difference between Standing Desk and Dim & Fill is that Dim & Fill is a very stable company in a very stable industry, and there is no expectation for dramatic changes. So the stable growth model works for that company. On the other hand, Standing Desk Inc. is a fast-growing business, and so they are expecting dramatic growth over the next few years, and therefore the stable growth formula model would not work. And so let's take a look at the historic income statement. This is actually a relatively straightforward income statement. There's not a whole lot jumping out as abnormal from year to year. As expected, this is a fast-growing company, and therefore revenue and both revenue and cost of goods sold were growing up very quickly. We did some analysis that's already been done for you. You saw that revenue growth rate was almost 90%, or almost double in the first year, and then it still increased by 50% the next year. Initially, the company's profit margin is all over the place. Again, that is not unusual for a new company because they have a lot of depreciation, and they are growing their businesses. So this is again not that unusual. Cost of goods sold fluctuate a little bit, and it may be stabilizing. Earnings before interest and tax, again, it grows. EBITDA, earnings before interest, tax, interest, depreciation, and amortization. Again, that grows significantly. It was losing money in the first startup year, which again is not unusual. And then it turned positive over the next 2 years. So this is the history. Next, let's take a look at what the buyer or the new investor expects. So we're going to go to table 5. So what we see here is the opposite. In here, the current management is making $100,000 a year. That is actually below market. If they are not working for their own company, they can expect or to hire someone who is a non-owner, they can expect to pay between $140,000 to $180,000 per year, an average of $160,000 a year. So the increase in management salary, so if you were going to pay market rate, it will be $60,000 more on average, and in the low case, it will be $40,000 more and $80,000 more if you end up in the high end of the estimate. In addition to that, the management benefit is very low currently, and they expect that if they hire someone at market rate, they will have to up the benefit. So total adjustment to the earnings before interest and tax and amortization and depreciation will include both the salary adjustment as well as benefit. So that the high end will be $85,000, the low end will be $42,000, and the average will be about $63,500. So now we are ready for our adjustment. So we're going to bring in the EBITDA. So this we already computed that from this is our current income statement. So we'll bring that in from table 4. So equals this is our EBITDA in year 0. So this is this year. And we're going to add our adjustment to it. Now, this case, the adjustment is a subtraction because this is an increase. So pay attention to the word. So it's very important when you create your financial model that you label it very clearly. So we are going to expect to spend an additional $63,500. So our adjusted EBIT in this case is actually going to be smaller instead of larger. And in the best case, we don't have to pay as much. So the low estimate is actually our best case because these are all increases in expenses. The high estimate is our worst case because if you have to pay $85,000, then our projected EBIT will be only $260,000. Next, when we move to table 6, we're going to look at what the free cash flow is like during the transition years. So again, they forecast out 5 years. They expect that they will continue to have exponential growth over the next couple of years. Then you're going to slow down over the next few years, and then eventually stabilizes. So we're going to do this for the first year. So first year, we're going to bring the projected EBIT from year 0, which is from table 5. So we use the expected value times, let's go back here, times 1 plus the growth rate. So year 1, the growth rate is 45%. And then next year is going to be year 1's projected EBIT plus or EBITDA times 1 plus the growth rate in year 2. And once we have done year 2, we can copy it over the next 4 years. Our after-tax cash flow is simply the projected EBITDA times 1 minus the tax rate in each year. So again, we are assuming 35% at this point, but the owner can easily modify this if necessary. Next, we have the reinvestment rate. We have computed that once. Remember that the reinvestment rate is the projected growth rate divided by the ROE. So projected growth rate in year 1 is 45%, and the ROE is 40%. So our reinvestment rate is 112.25 years. And we can copy this across to the next 5 years. Now you'll notice this is very interesting because our reinvestment is our after-tax cash flow times the reinvestment rate. So in year 1, your company is generating $265,879, but you projected you need to reinvest $299,114. So the free cash flow to equity holders, which is the after-tax cash flow minus the reinvestments. Again, this is an 100% equity financing. It's actually negative, and this is not uncommon. And this is because the company is growing at such a rapid rate. And this is where the entrepreneur oftentimes will need to look outside for new equity to help them finance this level of growth. Okay, so once we have our estimate, we can copy this over the next 5 years. And so you'll see that year 2, again, at such a high growth rate, the company continued to require cash infusion. So cash flow is negative. The owner or an outside investor will have to continue to invest in the firm. And then the firm will stabilizes to lower growth rate or slower growth rate, and it will start to generate positive cash flow to the equity holders. Next step is going to look at computing. We have free cash for the equity holders for 5 years. We have 2 more things to do. Next, we have to compute the cost of equity, and then we can also need to compute the future terminal value when the growth rate stabilizes. So in table 7, we're going to compute the cost of equity. And in this case, we were given all the input parameters. So we were given the unlevered beta, market return, risk-free rate, and notice that the current financial risk premium is 0. The reason for that is because the company is not using any leverage. If the company used debt financing, then you incur financial risk premium. You also have the unsystematic risk adjustment factor, and we're going to use the liquidity premium to adjust the discount rate instead of imposing a illiquidity discount at the firm value calculation. So here are the formulas that we have seen before. So the cost of equity, this is the unlevered cost of equity, is simply the risk-free rate plus the unlevered beta times the market risk premium, which is the market return minus the risk-free rate. Next, we have to compute the unsystematic risk premium, which is the beta times the unsystematic risk adjustment factor, which is 3.2176, and then times the market risk premium. And finally, to compute the cost of equity, we need to add the unlevered cost of equity plus the financial risk premium, even though it's zero in this case, plus the liquidity premium, plus the unsystematic risk premium. So now we have our cost of equity. Next, we're going to compute the terminal value for when the firm stabilizes. So in table 8, we're going to do that. So first of all, we're going to bring in our projected EBIT. So remember, this is year 6. And we assume that starting in year 6, the firm is going to stabilize to a long-term growth rate of 3%. So in year 5, that's from table 6. In year 5, the EBITDA is 1 million. And we need to multiply that by 1 plus the growth rate. And in this case, this is a long-term growth rate of 3%. And then next, this is the same as what we've done before. The after-tax cash flow is EBITDA times 1 minus the tax rate. And the long-term reinvestment rate is also the growth rate, 3% divided by ROA. Again, this is long-term ROE of 3%. So we have the reinvestment rate of 15%. So reinvestment is after-tax cash flow times the reinvestment rate. Again, we are still assuming zero debt. And the free cash flow to equity holders is after-tax cash flow minus reinvestments. And cost of equity, we computed that in table 7, so we can bring that over. Again, it just makes it easier so we don't have to go back and forth. And the free cash flow, the stable growth value or the terminal value is free cash flow to equity holders. So that will be the $582,000 divided by cost of equity minus the long-term growth rate of 3%. So now we have the terminal value. And we are ready for the last step. The last step is to compute the present value of all the cash flows, so the cash flow from years 1 through 5, plus the terminal value in year 5. And we're going to do that in table 10. So year 1, we computed that in table 6. So year 1's free cash flow to equity holder is a negative minus $33,000. And it's the same for years 2, 3, 4. But then in year 5, we have to include not just the cash flow in year 5, we also have to include, so add the terminal value in year 5. So the cash flow in year 5 is the sum of the two. And here are the cash flow. So you can compute the present value, or you can just compute using the net present value function. So if you use the net present value function, the discount rate is the cost of equity. So that's from table 8. And then the cash flow. In here, we start with cash flow in year 1. Notice that this is already cash flow in year 1. This is the total present value of all the free cash flow. So here is another approach to estimate a firm's value using the discounted cash flow method. Good luck.